prospect theory sort of loss aversion and diminishing sensitivity, but with the log value function on both sides of the kink. So is it not correct? So, oh, yeah, sorry. I'm yeah, that's supposed to be 1 over s. Thank you. So you do the problem set. Part of the problem set is going to ask you about risk aversion in the domain of gains, which is no different from expected utility theory, because we're ignoring the kink and we're ignoring the reflection effect. You take a look at the kind of risk aversion that's implied by log utility. You decide whether you think that's a lot of risk aversion or not. There's quite a lot of empirical evidence to suggest that this is actually pretty close to real-world risk aversion. And Merrill and Prescott have demonstrated that in order to explain the equity premium puzzle with expected utility theory, investors would need to be 30 times as risk averse as that. It's not plausible. Okay? So we have the familiar implausibility argument. And so this has stood as a puzzle, or it did stand as a puzzle, starting in 1985. So, tell me your name. Tell me your name again. David. So what David is saying is that it's not just the average that we care about; it's how the spread, right? You might have really long tails. Apple stock can make you fabulously wealthy. Enron stock can make you fabulously not wealthy. And in between, there's good old IBM, which just chugs along, churning out relatively tightly distributed returns. Not according to Merrill and Prescott, because they had access to that data. Okay, but the shape of the distribution of these stocks is going to come up in a few minutes, hopefully. Yeah, Andrew. No, I'm sorry. I need to think about that for a second. It would just be a lot. It would just go flat much faster and much flatter. No, not much flatter. It would curve down. It's not that it would become flat as in straight. It would curve down. So this thing scales the curvature by the slope, so that when you get way out here, it looks less bendy because it's starting to get flat. But relative to how shallow it's become, it's still actually very bendy. So it would just be much bendier. Okay. So Bernard and Thaler used prospect theory to solve the equity premium puzzle. So let's look at the following stylized example, which is from their paper, which they wrote in 1995. Well, they published it in 1995. So suppose we take an investor, not even an investor, just a person who has really, really simplified loss-averse value function like that. So it's exactly the same as what we used before when we were looking at mugs and money, except it's got 2.5 here below the kink instead of 2. Okay? And suppose you offer them, as Dick Thaler has many, many times with his colleagues apparently. Actually, I think it was Paul Samuelson who first did this. What if you ask them, would you be willing to accept a gamble in which you gain $200 with probability 1/2 and you lose $100 with probability 1/2? The expected value of this is $50. Okay? The prospect theory expected utility goes like this. And we're going to assume linear probability weighting because that's not the part we care about right now. So we're just going to simplify. And we're going to say that the utility of this gamble under prospect theory with that value function would be 0.5 times v of 200 plus 0.5 times v of negative 100. And if you do the math, that is 100 minus 125, which equals negative 25. And so because of loss aversion, you would reject this better than fair small stakes gamble. Okay, we've seen that before. Now, what if I asked you, would you like to accept that same gamble twice in a row? Right? So if I lump that together twice in a row, I get this gamble. With 25% chance, you get 400. With 50% chance, you get a mere 100. And then there's still a 25% chance that you lose, but now you lose a little bit bigger, you lose 200. That's what you get if you put together the outcomes of the two gambles into a single sort of compound gamble. So what does this prospect theory value function tell us? Well, that's 0.25 times v of 400 plus 0.5 times v of 100 plus 0.25 times v of negative 200. And if you do the math, you get 100 plus 50 minus 125, which is equal to 25. Okay? So even under prospect theory, just giving you that gamble twice should make you say yes. Because we've reduced the negative outcome and the probability, we've increased the size of the negative outcome, we've reduced the probability of it enough that the loss aversion is not scaring you away. But what if you feel the loss or gain for some reason after each roll of the die or each flip of the coin? What if what happens is I say, flip it, do you want me to flip it once? I flip it once and I give you the money or not the money and you evaluate how you feel about it. And then I flip it again and you evaluate how you feel about it separately, right? And then you think in advance, how would I feel about suffering that gain or loss on the first gamble and then suffering that gain or loss on the second gamble? If that, for some bizarre reason, was psychologically how you experience those outcomes, then what you get is you just get this negative 25, right, on each roll. In expectation, you'd have a loss of utility because of loss aversion on each roll. And so if you think about the combination of the two as being somehow bizarrely gain or loss once, gain or loss twice, then your prospect theory utility for that would be negative 50. And you'd say, no, I don't want that. I don't like that. Right? And I could give you more and more and more of these gambles and you'd like it less and less and less. Where if you're combining them together the way you kind of should be, you'd be liking it more and more. If you evaluate them individually, you like it less and less. Okay? So this is what in behavioral economics is called narrow framing. And it comes up in lots and lots of places. So you frame these outcomes one at a time instead of lumping them together. So what Bernard and Thaler do is they say, what if people experience gain-loss utility every time they look at their stock portfolio? Now, I don't know how many of you have a stock portfolio. I have a small one. It's growing, I hope, fairly rapidly now that I have an actual job. But having read this paper, I never check my portfolio. Never. I get these things in the mail. They say Sentinel. They say Fidelity. I say, nope. I don't even open them. I don't want to know because that money's in there for my retirement, which is 30 years out. Because I anticipate by the time I retire, the retirement age will have gotten up to where it should be, which is at least 70. I don't check my stocks. Because I know that I'm going to experience gain-loss utility every time I look at them. I know because I used to check my stocks, and it sucked. You know, it's like, how have you lost me even more money? It's like, Dan, don't worry, you've got 30 years for it to grow. So if that's what's going on psychologically, then the more frequently people check, the more likely they are to feel a loss, right? Because this thing's bouncing up and down. I don't know if you've noticed this, but there's a lot of bounce in that thing. what these guys showed was that if they take the value function and the probability, did they use the probability? I can't remember. They used the estimates from Tversky and Kahn in 1992, and they plugged the data from the actual stock market from 1926 through, I guess, 1990 something or other. And what they found was that if people check their portfolios about once a year, then prospect theory predicts a 6% equity premium. Okay? Seems not totally unreasonable. It seems like a much more reasonable estimate than they just have 30 times the normal level of risk aversion. Okay. Doesn't prove anything. It's not science, but it's fun. Very briefly, I should probably skip this. You should just read through this. Fama and French are like the gurus of financial markets and formal modeling. And so just very briefly, what's going on here is that Eugene Fama says the equity premium puzzle it's only a puzzle because the expected utility model that can't explain it is silly. Okay, so that's an expert who believes in rational markets saying, oh, that model's silly. And so then his partner, Kenneth French, comes along and says, well, I agree with Gene. And that leaves the fascinating question, what is wrong with our models? This paragraph is a bunch of things that standard economists have tried to do to tweak it. And this is Ken French's idea of what the right answer is. And he said, basically, Bernard and Thaler offer a totally different solution, blah, 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 blah. When I think about my own preferences, which is not something that standard economists should ever do, because they should just be looking at the math, when I think about my own preferences, this argument seems reasonable to me. So that's what Fama and French think about this. If the experts think prospect theory is a better model, why don't they use it? And the answer is the same as what I've said a number of times, which is, the model's not complete. It includes this weird thing about framing. It includes, assumptions about what the reference point is, blah, 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 blah. Not that makes it unbelievable, it makes it unusable for actually estimating things with real data. For actually predicting things in the real world. It makes it unusable. So we have work left to do. Okay, here's another application. Low returns on lottery-like stocks. Now, this is going to bring us back to David's observation or comment about the distribution of returns rather than just the expected returns. So we can think of a lottery as being an investment with skewed returns. So what do I mean by that? Let's just have like a distribution of returns. A symmetrical distribution of returns might look something like this, okay, where there's the expected return, and then, there's sort of an equal distribution of probability that it winds up being big or it winds up being small. And what David was talking about was, what if those tails go really far out so that you could get really rich or really poor? What I want to look at is something slightly different than that, which is, what if you have a very skewed investment where there's a lot of probability on you making just about nothing, and then a really long tail that stretches out to a very small probability of you getting fabulously wealthy, okay? So if you bought Google the day it came out, you're not in this classroom. You're on a beach somewhere. It turns out that a lot of IPOs, so this is like a lottery, right? With very, very high probability, it has a return of you lose everything, which is your dollar or $5, whatever it is. And with a very, very tiny probability, you're on a beach somewhere on a desert island or whatever. Beautiful, beautiful scenery. IPOs, initial public offerings, are often like this. So very, very promising firms, when they put out their first public offering, their first round of stock, very frequently the expected returns on those stock are heavily skewed, right? So you might lose, it's not that expensive, you might lose it, but you might become fabulously wealthy. It turns out, as Green and Plan discovered, when they looked at this is an unpublished paper, but it's copied on BSpace, these highly skewed IPOs earn a higher than usual return on the first day, because everybody's out there saying, I want that skewed lottery ticket, I want to buy it. So the firms that put out these skewed IPOs make a huge amount of money on their IPO, but they make lower than usual returns over the following 1 to 5 years because, people were too enthusiastic. The returns are not commensurate with the money they got put into them. Another paper, Boyer, Nissen, and Forkink in 2010 looked at not just skewed IPOs, but all New York Stock Exchange traded stocks over a long period of time, and they found that those stocks that had high expected skewness have lower returns. And also, by the way, another puzzle they explained that those with really high volatility also have lower returns, but that's because really volatile stocks, which is what David was getting at, typically turn out to be positively skewed in their returns. They typically wind up being the kind of stocks where you might lose your shirt, but you might get fabulously wealthy. Okay, so what's going on? If people are overweighting small probabilities, they like the possibility of hitting the jackpot, and therefore the demand for these skewed stocks is high, which drives up their price. Okay, but the return is how much they pay off divided by the price. So if there's excessive demand for these skewed stocks, that drives up the price, that drives down the returns as a percentage of the price. That's what's going on here. People have sort of, not irrational, but you might want to say, if you're actually saving for your retirement and you actually care about the possibility of winding up dead broke at the age of 70, this is not such a great idea. Okay. Does that get a little bit of what you're thinking of, David? Okay. Now we're going to talk about deal or no deal. On the one hand, this is just kind of fun. On the other hand, it's actually relevant. It's meaningful. Okay? So economists worry a lot, as we've seen over and over again already, a lot about what's called internal validity. Is there a confound that could explain your results that would therefore make your data or your test not a valid test of theory? So we've seen lots of examples of that, both in observational data and even experimental data. But that could be explained by competition among the bicycle messengers. It turns out that they controlled econometrically for that. This could be explained by the fact that lazy drivers show up on high-wage days. Okay, well then we'll run a field experiment that eliminates that possibility. Okay, so that's all internal validity. And you typically solve internal validity by doing experiments. And the problem is that you then run afoul of concerns about external validity. Okay, it looks great in the experiment, but what about in the real world? What about external to the experiment? How valid is that? What if you did it in a real market, or what if you did it with real stakes, large stakes? Okay, now, ideally, and very expensively, what we like to do, what I like to do, what a lot of behavioral economists like to do, is to solve both problems with a field experiment where we actually go into the real world and try to engage people with real stakes, like the bike messengers who got a 25% increase in their wage. That's real stakes, right? Or you go to a place like Vietnam where people are highly literate but very, very poor, and you give them what would be small stakes here, and to them it's big stakes. Okay, Post et al. In 2008 tried something different. They solved both problems by looking at data from Deal No Deal. Is everybody, the people, I don't watch television, so I haven't learned about this show from reading this paper, but I'm guessing that most of you have heard of Deal or No Deal? Okay. It's basically a field experiment on television. So for those of you who don't know, which may just be me, so a contestant is confronted with 26 suitcases, each with a different hidden prize, and they pick one of them, and they pick one of them at random without seeing its contents, and that's their prize. They get to own that not their prize, it's their suitcase. Okay, so they know the range of possible prizes, but they don't know which one's where. And then in each round of the game, some subset of the remaining 25 suitcases are opened up, revealing their contents, and they contain different money amounts, right? So with each round, at first, there's a 1 in 26 chance that your case is any of those different numbers, and so there's an expected value of what's in your case, which you can compute very easily, right? If you open 6 in the first round, you change the expected value of what's in your case. If all the suitcases you open have low values, then the expected value of your suitcase went up, and if all the suitcases you open in the first round have high values, then the expected value of your suitcase went down. And then after opening those cases, then the banker offers you a deal. Offers you a deal. Would you like some fixed amount, X, which is called the banker's offer, and then walk away? That's called making a deal. Or would you like to reject that deal and keep playing, keep opening more cases? That's called no deal. Am I getting this right so far? Okay. The banker's offer, as it turns out, goes up and down depending upon how the expected value of what's left in the unopened cases changes, according to a fairly fixed set of rules. So if you open a bunch of low cases and now your case has a higher expected value, then the banker will offer you a higher walk-away offer. And then whether or not you take the deal tells us something about your risk aversion. Okay? So it's internally valid, because it's set up like an experiment, and externally valid to the extent that the stakes are huge. In the European show, the Dutch show, I think it is, the maximum prize is 5 million euros, and the average prize that people walk away with is 500,000 euros, which is what now, about $700,000. This is real stakes. This is not, $500, $550. So this is what the viewers see. They've got all of the values there. The ones that have been opened are grayed out. The contestant can do the math on the spot, we assume. They know that the probabilities are equal, so you just add those numbers up and divide by how many of them aren't grayed out, and that's the expected value of what's in your suitcase. Straightforward. And then you just compare it to the banker's offer, right? So this is the bank offer. And this is basically just like problem 3 from Kahneman and Tversky. You want this risky outcome with some expected value that you can perfectly capable of, but just assume all these people have a third grade math education. Or do you want a certain outcome, which is going to be less than the expected value of what's in your suitcase? Okay? Deal or no deal? Here's what they found. They went and looked at the later rounds of this game, or anything other than the first round, and they categorized people into situations where the news that they had just received was neutral. It didn't change the expected value of their suitcase much. Where the news was positive, they opened a bunch of low suitcases, so the expected value of their suitcase went up. Or they opened a bunch of high suitcases and their expected value went down. What they found was that contestants become less risk averse after they receive bad news. Okay, I'm not going to cover that bullet point. And they also become less risk averse after good news. So they turn out to be very risk averse when the news is neutral. But if they get good news, they become less risk averse. And if they get bad news, they become less risk averse. I don't have time to cover this, which is a shame, because this is a really cool graph, but it's in the paper. And basically what they've done is they've said, let's just model a 50-50 gamble where you get 25,000 or 75,000, and let's have 3 different reference points. 1, you just got some neutral news. 1, you just got some good news. 1, you just got some bad news. And let's look at what your certainty equivalent would be, right? And it turns out this is going to be the neutral news certainty equivalent. This is going to be the bad news certainty equivalent, and that's the good news certainty equivalent. And sure enough, you become less and less risk averse as you go from neutral to bad and from bad to good. Okay, your certainty equivalent. Sorry, did I get that the wrong way around? No, that's right. You become less and less risk averse. Your certainty equivalent goes up. So take a look at that in the paper. This graph is in the paper, and it's pretty well explained. And this phenomenon, where these certainty equivalents change depending on how your reference point has changed, is problem 1 of the problem set. And I will see you on Tuesday for exam review. Email me with your questions.